Hey everyone, and welcome back to the channel where we demystify the complex world of hard-to-borrow stocks and short squeezes. Today, we're diving deep into a fascinating ticker that's recently landed on our screener, LGCL, Lucas GC Limited. We'll explore why this stock is drawing attention from short sellers and what its extreme cost to borrow might mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/stock chart. Let's get straight to Lucas GC Limited, ticker LGCL. This company operates in the technology sector, specifically software application, with a current market cap of around $56.09 million. Through its subsidiaries, Lucas GC provides online agent-centric human capital management services based on a platform as a service, or PaaS, model primarily in the People's Republic of China. They offer recruitment services, including both flexible and permanent employment solutions through their Columbus platform. Show price chart. Looking at recent price action, LGCL has seen a modest plus 0.76% today, with a plus 3.10% gain over the last 5 days, but it's down about minus 25.28% over the past 30 days. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow, and why is that important? When you short a stock, you're borrowing shares, selling them, and hoping to buy them back later at a lower price. But borrowing isn't free. The cost to borrow, or CTB fee, is an annualized interest rate that short sellers pay to borrow those shares. When a stock becomes hard to borrow, the supply of available shares shrinks and the demand from short sellers increases. This drives the CTB fee sky high, sometimes well over 100% annually, as short sellers compete for the limited supply. It's essentially the price of admission to bet against the company. Why the stock is hard to borrow right now. Highlight CTB numbers on screen. Now let's look at why LGCL popped up on our hard-to-borrow screener. The numbers here are truly striking. LGCL currently has an annualized cost-to-borrow fee of a staggering 609.5%. To put that in perspective, that's what short sellers are paying per year just to hold their short positions. What's more, this fee has exploded, showing a plus 604 percentage point increase over just the last 5 trading days. This intense momentum suggests a very rapid tightening of supply. Show shares available number. Currently, there are only about 15,000 shares of LGCL available to borrow. When you compare that to its estimated float of 1.6 million shares, you can see how incredibly scarce borrowable shares have become. Today's volume for LGCL was 130,550 shares, which is significantly lower than its 30-day average volume of 5,024,611 shares, meaning the relative volume today was practically 0x average. Our internal composite squeeze score for LGCL, which combines CTB, momentum, supply, and other factors, currently stands at 48.7 out of 100. Squeeze mechanics explained. So, what does the scarcity and high CTB mean in terms of a short squeeze? A short squeeze occurs when a stock's price starts to rise, putting pressure on short sellers. With LGCL's borrowable shares down to a mere 15,000 and the cost to hold a short position above 600%, any significant upward price movement could trigger a chain reaction. Short sellers facing mounting losses and exorbitant fees might be forced to cover their positions, meaning they have to buy back shares in the open market. This sudden buying pressure can further drive up the price, forcing more short sellers to cover, creating a self-reinforcing upward spiral. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction in their bearish thesis, even if it's expensive to maintain. Dilution risk check. Before getting excited, let's address dilution risk. Dilution happens when a company issues new shares, which increases the total share count and can reduce the value of existing shares. Even if a stock has a high CTB, new share offerings can provide short sellers with an easy way to cover their positions or could simply negate any upward price momentum by increasing supply. Our checks show no recent diluted SEC filings such as S-1, S-3, or 424B for LGCL in the last 90 days. This absence of recent dilution risk is generally a positive for any potential short squeeze thesis. We also found no recent reverse splits for LGCL in our look-back window. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For LGCL, given its current setup, what should you be watching? The most immediate factor is at the astronomical 609.5% cost to borrow and its rapid increase of over 600 percentage points. The fact that there are only 15,000 shares currently available to borrow, compared to a 1.6 million share float, is also a critical indicator of extreme scarcity. Any sudden increase in buying volume, especially on days like today where its relative volume was 0x average compared to its typical 5 million shares, could quickly overwhelm the limited supply and potentially ignite significant price action. Pay close attention to sustained positive price momentum and any further shrinking of that tiny borrowable share count. However, always remember the balance. Short sellers paying such high fees often have deep conviction, so understand their perspective too. Lucas GC Limited, LGCL, presents a truly compelling case study in a hard-to-borrow stock with extreme scarcity and a rapidly escalating cost to borrow. While these factors suggest potential for a short squeeze, it's a high-risk, high-reward situation that demands careful research and understanding. If you found this breakdown insightful, please like this video, subscribe to the channel for more deep dives, and let us know in the comments what stocks you'd like us to analyze next.